Less is not more here. Bigger is apparently better when it comes to all types of structures, but especially the IPO. Have you ever wondered what's really happening inside the microcap markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Microcap Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman. Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most committed and ambitious entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or just operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a clear, real-time view of what's happening in the microcap markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, and secondary offerings across all aspects of the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
I'm Caroline, and welcome to Inside the Microcap Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the microcap ecosystem and break them down in a live question and answer format for Joe to give you his take from the trenches. Before we get into today's questions, Joe, just tell us from a high level a little bit more about what you're seeing there on the front lines of the emerging growth ecosystem.
Thank you, Caroline. So what we're seeing right now is not just a slower market like a lot of people are saying. What we're really seeing is a market that's both being elevated and redirected at the same time. Let me explain what I mean. So if you compare Q1 of 2026 to the first quarter of 2025, the shift in the number of deals is pretty dramatic. Remember, traditional microcap IPO volume dropped 88% year over year because of all the new listing rules that came out in 2025 on both NASDAQ and the New York Stock Exchange. But here's the fascinating thing. At the same time, uplistings, cross listings, and direct listings really picked up. Now, that doesn't mean that the same companies are simply choosing different paths. They're not. What it means is that in this market, and really the people operating in it, are putting a lot more time and energy into alternative paths simply because the traditional IPO market has gotten a lot tighter and harder.
We're going to have to break that down a little bit more in a second. But before we get into some of today's questions, Joe, let's just level set here for everyone. In case you're joining us today for the first time, these are real questions coming out of the market right now from companies, boards, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions@lucbro.com. And maybe we will cover it on a future episode. So let's start off today, Joe, with this question. If you isolate just the traditional IPO market, how different was Q1 2026 from Q1 2025?
Well, isolating just the IPO market, you will see that the quarter over quarter data looks dramatically different. And to just step back for a second, remember, 2025 was a major year of transformation and upgrade for both the NASDAQ and the New York Stock Exchange. Both exchanges passed a number of new rules designed to elevate the emerging growth market, really culminating in December 2025 with NASDAQ passing the most sweeping set of rules that I think we've seen in really the last decade. So if you look at the microcap IPO market in Q1 2025, there were 42 microcap IPOs. I mean, think about that, 42. And about 30 of them were from foreign private issuers, which obviously means there were only about 12 domestic deals. And another thing that's really interesting is that NASDAQ dominated those 42 microcap IPOs with about 88% of market share. And curiously enough, the market raised over $731 million. But here's the kicker. The median offering size was only about $8 million.
And then when you fast forward to Q1 2026, what changed?
Now, fast forward to Q1 2026, you only had 5 microcap IPOs in total. I mean, in the entire market. Every one of them also was domestic. There were no foreign private issuers at all, not one. And the exchange mix really changed up too. 3 out of the 5 of those microcap IPOs went to the New York Stock Exchange, or 60% of the market. But just think about that. There were 37 NASDAQ IPOs in Q1 of 2025, basically 87% of the market. And in Q1 of 2026, NASDAQ had 2, which represented 40% of the market. I mean, those numbers are astonishing. Another important data point to go along with sort of the volume drop, which is super critical, is that the total capital raised went from $731 million in Q1 of 2025 to a measly $94 million in Q1 of 2026. Again, staggering drop in the market. And here's the most telling data point, I think, right now in the entire microcap industry, and that is really the median offering size. Remember, last year, there were 42 deals that raised a median offering size of about $8 million. Compare that to 2026, when the median offering price was $20 million. So we had 42 deals, $8 million median offering size, to 5 deals with a $20 million offering size. So Caroline, if you're just looking at IPOs, the microcap IPO market got a lot smaller and a lot more selective with a lot higher quality deals in Q1 2026.
So just on the IPO side alone, it really was a completely different market than what we saw a year earlier.
Oh yeah, completely different. If you only looked at the number of IPOs and not the underlying data or the trends, you would say, like a lot of people in the marketplace are currently saying, that the market just got tighter, or it's a slowdown or something like that. And that would be partially right. But really, Caroline, that's not the whole story.
Okay, Joe, let's get into it then. What do you mean it's not the whole story?
Well, when you look beyond the IPO market, you start really seeing something else. And that is that uplistings and cross listings really increased from Q1 2025 to Q1 2026, meaning that there were 2 deals in 25 and really 6 deals in 2026. And really the same thing for direct listings. There was 1 direct listing in Q1 of 2025, and there were 7 deals, 7 direct listings in 2026. That's why I say that it's not just a slower market. It's a market that is really rerouting in other ways, but you need to look at the underlying data to figure that out.
And yeah, just to be clear, Joe, are these the same companies as the IPO companies? Meaning any company can just choose their preferred structure?
No, not at all, Caroline. These are generally different types of companies, and that distinction really matters. So let's step back for a second. Remember, private companies go public through IPOs. OTC traded companies generally uplist, and foreign companies generally cross list. Direct listings, they're a little bit different and generally reserved for a different kind of private company, one that maybe is a little bit more mature, often has a larger legacy shareholder base, and traditionally doesn't need to raise capital at the time of listing. Although I fully admit that most direct listings in the microcap do raise money either just before or at the time of listing. So this isn't really about the same bucket of companies simply choosing, a different path. It's really about the market and the ecosystem, and where the bankers and lawyers and advisors and consultants are really putting their time and energy sourcing these different alternative pathways.
So what you're really saying is that these companies didn't just change overnight. The market just simply became more focused on the companies that actually fit these alternative pathways. Is that right?
Yeah, that's right. And that's a much more accurate way to understand what happened in Q1 of 2026. This is really about sourcing and trying to execute on more of these kinds of deals, because compared to where the IPO market is right now, these alternative paths look much more attractive than they really did a year ago or 2 years ago.
Let's just talk about those paths here one at a time. Can you tell us more about the uplist and crosslist market?
The uplist and cross-listing market data is very telling, because remember, when the IPO market was easier, the uplist and cross-list market really became challenged. Also remember that back in 2022, NASDAQ changed its rules. So you can no longer do a simultaneous reverse split and a listing on NASDAQ the same day. That took the market a little bit of time to figure out. So the uplist market immediately cooled off back then, and it took a few years to slowly work its way back to normal. Now in 2026 and beyond, I think, if you're an OTC company and you can trade an average of 2,000 shares per day for 30 days above $4, you may be able to list on NASDAQ without needing the same kind of $15 million minimum capital raise that you would need if you were pursuing a traditional IPO. That's a very meaningful advantage for companies right now. So in Q1 of 2025, there were only two uplist and cross lists. Both were domestic and both were on NASDAQ. And I think both of them also raised capital. Now compare that to Q1 2026, where the IPO market has gotten a lot tougher. You've had 6 uplist and cross list, and 4 of those were on NASDAQ, and 2 of those were on the New York Stock Exchange. But here's the real interesting point about that. The mix was split evenly between 3 domestic companies and 3 foreign private issuers. Remember, we talked earlier that all of the microcap IPOs in the first quarter were just domestic. Well, here we're seeing that there's a little bit of an opening for foreign private issuers in the uplist market. It's a really, really important point. The other thing I'll just point out is that 2 of those 6 uplists were organic, meaning they didn't raise money. They were just trading and they uplisted to NASDAQ. One was, I believe, from the United States, and the other one was from Israel, which is a fascinating market by itself.
And it seems one of the biggest reasons that matters is because the uplisting path still holds one of the last real exceptions to the 15 million capital raise expectation. Is that right?
Yeah, Caroline, that's right. And that's really one of the biggest practical reasons that the uplist market matters so much right now. Because remember, for the right OTC company, that uplisting path still offers one of the sole remaining real exceptions to that $15 million minimum capital raise rule that now defines so much of the traditional IPO market. That doesn't mean it's easy, by the way, because trust me, I can tell you that it's not. But relative to where the IPO market is today, it's one of the last meaningful openings left in the industry. And I believe the ecosystem is putting a lot of resources into that structure right now.
And what about direct listings? Because that's a different kind of company too.
Yes, it's definitely a different kind of company. Direct listings are not just a substitute for an IPO. They're usually a better fit for companies that are slightly more mature, generally have a large shareholder base or legacy shareholders that they can use for the listing process. And they generally don't need to raise capital at the time of listing. Although for microcap direct listings, most of them do raise money either at the time of listing or in a private deal just before. But just because they're mature doesn't mean they're successful. Don't confuse the two. Mature just means they've been around for a while and have a larger legacy stakeholder or shareholder base. And on the direct listing side, the shift in Q1 was even more dramatic than the uplisting cross-listing market.
Tell us more about that, Joe.
Well, in Q1 of 2025, there was only one direct listing. That was a domestic company that listed on NASDAQ, and they opened about $8. Generally a very successful deal. In Q1 of 2026, there were 7 direct listings. 7, up from 1. And 6 of them were domestic. And again, one of them was a foreign company. Here again, we're seeing that foreign private issuer. Again, we didn't see any of the microcap IPOs. All 5 for the first quarter were domestic. We saw 3 foreign companies in the uplist cross list. Now we're seeing another foreign company pop up here in the direct listing. Let me tell you a little bit about why I think that is the case. Because remember, in an IPO, you have to have an original book with real dollars being committed and real trading going on, at the time of the IPO. So NASDAQ has an interest to make sure that those investors have been vetted and that in their view, volatility isn't going to be crazy out of the gate for the IPO. For an uplisting and a direct listing where the company's been trading a little bit, has some history, maybe they raise some money, maybe you don't, it seems to be a little bit more stable, especially for the direct listing as well, because you're just registering legacy shareholders. There's no real push at the beginning like there is in an IPO. And I think that's where we're starting to see the foreign companies go more because you don't have that deal concentration or that concentration and distribution analysis taking over the listing process. So again, Caroline, the takeaway here is not that the microcap market went away like so many people are saying, is that a lot more activity started showing up in these alternative paths to the public markets as the IPO rules changed and got a lot tighter.
So, why do you think that these direct listings start to look more interesting in that kind of market?
Because the economics and the approval dynamics start to matter a lot more. When the traditional IPO route gets harder, more expensive, and really much more discretionary, companies and bankers start asking, practical questions. Is there a smarter way to get listed for certain companies? So direct listings became more attractive because they offer a different route to the market. And most importantly, the exchanges look at them differently and generally safer than an IPO. You're not dealing with the exact same deal dynamics as you would see in a traditional IPO. In some cases, the alternative path can feel a bit more streamlined because there's no deal qualification, no concentration and distribution analysis, and fewer hurdles that you would normally be dealing with than if you were doing a traditional IPO.
And I believe there's also a foreign issuer nuance there, right?
Yes, especially for those foreign private issuers. And we're seeing that in the data from Q1 2026. So, for the right foreign private issuer, a direct listing probably deserves a harder look because it can really take that deal qualification piece out of the process, out of the listing qualification, meaning since there are no new shares being offered, like in a traditional IPO, that is generally looked upon as a little bit less volatile of a transaction. And that's really good news, in my view, for the qualification process. So that doesn't mean that it's easier or that NASDAQ is approving foreign private issuers more who do a direct listing. In fact, the opposite is really true. I'm just saying that as an alternative pathway, it seems to me that the foreign companies are finding a pathway that maybe didn't exist a few months ago.
Yeah, that's actually really interesting. Can you explain what you mean by that, Joe? I'm sure everyone's wondering the same thing.
Well, remember, after the volatility and trading issues that the market saw in a number of offerings back last year, NASDAQ moved in December 2025 to give itself much broader discretion under the new IM 51013 rules, which is their new discretionary rules, to deny really any listing, even when a company meets all of the technical standards. And the concern there was really market manipulation and high volatility, including, other concerns around outside advisors and really about the jurisdictions of these companies, how sophisticated the boards are, and whether or not there's really recourse available to U.S. regulators and investors for some of these foreign jurisdictions. So the right foreign private issuer, if a direct listing is available and the company is otherwise properly set up for it, meaning in their structure, that path may be strategically cleaner than a traditional IPO in some situations because you're removing some of the risk factors from the listing process by going to a direct listing instead of a traditional IPO. But again, it doesn't work for every company. So you just have to kind of figure it out and see what works for your company. And I want to just say again, that doesn't mean it's going to be easier or that it's easy. It just means for the right companies, it could be a better route instead of the traditional IPO.
And more broadly, is this where the industry can get lazy and just default to an IPO because it feels familiar?
Oh, yeah, for sure. And I think this is where a lot of companies still miss the strategic analysis that needs to be done. See, most companies naturally think that, you have to do an IPO really because historically that's been the default pathway. And in people's minds, it's also the most familiar, right? Just do an IPO. But in reality, certain companies may actually be better set up for a direct listing, but they never seriously think about it because, again, their mind is defaulting to the traditional IPO. Well, I think in 2026, that narrative is being changed.
What do you mean by that, Joe? Can you give us an example?
Sure. So, for example, Caroline, if you had a company that's been around for a number of years and has a fairly large shareholder base, meaning they raised capital a number of times before, and maybe they only have 100 shareholders or 200 shareholders, and they're not really interested in raising $15 million out of the gate like you would have to do in a traditional IPO. If you have that type of company, then a direct listing probably deserves a much harder look. Now, that doesn't mean that a direct listing is the automatic answer or that it's even easier. It just means that you have to do the strategic analysis and stop relying on assumptions of the past where everyone in the industry is defaulting to a microcap IPO. Because I do believe for the right foreign companies with the right structures, a direct listing can be a wonderful alternative.
So, if you're a founder, a board, or even an investment banker looking at this quarter right now, what should you actually take away from it?
Well, the first takeaway is this: stop thinking only in terms of the IPO. If you're trying to get a company public in 2026, you really have to think more strategically and more broadly than that. The question really is no longer, can we do a traditional IPO? Although that's a good first step and a good first question, it's really now just one factor in the decision making process or the decision tree. I think the better question now in 2026 is, what is the smartest path to market for your company, given the way the rules have changed over the last 12 months for both the NASDAQ and the New York Stock Exchange? And really, where is the market now in the capital raising environment? Meaning, where is it functioning right now in 2026? All of those factors have to be considered and not just defaulting to, hey, we're going to do an IPO.
And what is the IPO market telling people right now?
Well, I'll tell you, it's clearly telling everyone that the bar is much, much higher. You know, I've said this in the past, and I think we said this on a previous episode. Less is not more here. Bigger is apparently better when it comes to all types of structures, but especially the IPO. I mean, think about this: going from 42 microcap IPOs to 5 year over year, while the median offering price jumped from 8 million to 20 million. That is not a random coincidence. That tells you that smaller, weaker, borderline deals, more marginal IPO transactions are having a much harder time clearing. In fact, they won't clear in this new environment. So bigger, in my view right now, is generally better. And that may change as the exchange starts to figure out how to implement some of these new rules. But if you're doing an IPO in the second quarter, third quarter of this year, plan for bigger.
And what does that exactly mean for the alternate listing paths?
Well, it means that they matter a lot more right now in the microcap ecosystem. I mean, uplists matter more, cross lists matter more, and direct listings really matter right now in 2026. And this is now a market that is really rewarding creativity and good analysis regarding the structure of your transaction. So for founders and bankers who are still walking into this market with a one-track IPO mindset, they're going to have a much harder time getting over the finish line when they're not considering the alternative pathways that are available. So I would say that everyone should really do a strategic analysis to see what pathway is best for their company.
And do you think that takeaway will change depending on who's listening, whether it's a founder, banker, or advisor?
Oh, yeah, absolutely. I mean, I think if you're a founder or a CEO or part of a C-suite management team, the takeaway is that you have to absolutely stop assuming that there is only one pathway to getting public, meaning the traditional IPO. If you're an investment banker, the takeaway is that, structure matters more now than ever. And you have to be really realistic in this environment about what kind of company belongs in what kind of process and on which exchange. And I think if you're an advisor or a consultant or other professional in the space, the takeaway really is that, your client needs more than generic IPO advice right now. They need a real pathway analysis and, even more importantly, a real advocate to go in front of the exchanges and not just be a paper pusher or a processor. Because what this quarter, Caroline, has really shown us is that this market is becoming more path dependent and more advocacy dependent. It's a much more strategic conversation than it was just a year ago.
So, bottom line, Joe, what is the real story of Q1 2026?
The real story of Q1 2026 was it's not just a weaker IPO market. It was a much more selective market with the industry really starting directing its resources and its attention and energy to these alternative pathways. And that's really the takeaway. Traditional IPO volume dropped. The market became much more domestic. Deal sizes increased by a tremendous amount. And at the same time, the uplist, cross list, and direct list market became much more active. So the market didn't disappear as a whole. It really just adapted and rerouted to these alternative pathways. And I'll leave you with this, Caroline. For founders, boards, and investment bankers, basically the people that we speak to every day in the ecosystem, for those of them who understand where this market is moving, and more importantly, which pathway actually fits for their company, well, they're going to be in a much better, stronger position to get listed in 2026 and beyond, because that traditional microcap IPO market is really no longer here.
You've been listening to Inside the Microcap Markets with Joseph Lucosky. For more insights from the trenches of the microcap markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@luckbro.com. That's questions@LUCBRO.com. Thank you for listening, and we look forward to next time.